Well, it gives me great pleasure to bring on board Mr. Chandrasekar K, the CFO of Page Industries, to talk about what's happening to the comfort brand and the innerwear segment in terms of demand and in terms of growth in this period of pandemic crisis. Mr. Chandrasekar, good morning. Thank you for joining us. Hope everything is fine, safe at your end with your employees and with your family members.
There is a significant improvement in demand, at least as far as we are concerned. When I look at April, it was zero sale. In May, it was down about 80%, and June was about down 40%. But since then, July is down about 30%, and August we are ahead of last year. All these numbers are compared with last year. So we have experienced good uptick in every consecutive month, and therefore our outlook still remains very positive and optimistic for the rest of the year.
Now, when you say that numbers were higher than last year, you're actually confirming to us that your sales have already gone above the pre-COVID levels.
Exactly. As far as August is concerned, yeah.
So is this a pent-up demand which came largely because of the lockdown, or do you think this is a trend in making where sales have genuinely normalized and the consumer in a sense is back now?
I will not hasten to say that it is a pent-up demand, because the build-up has been gradual. Q1 was only hardly 1 month sale. But since then, I think people have learned to live with COVID and manage their life and work around it. And the demand is coming back. For your information, the secondary sales, which is the sale from our distributors to the retailers, is more than the primary sales. So all the indications are that things are getting to as far as good as normal can be.
One large change, Mr. Chandrasekar, what you've reported for the quarter gone by is a big uptick in your e-commerce sales. Is this a trend in making? And if this is a trend in making, how will this be a differentiating proposition? Because if you're selling more towards through the e-commerce platform, then your entire distribution cost changes, then your entire channel partner cost changes, then your retail cost changes. Is this a trend in making for Page Industries?
In terms of e-commerce, yes, if you look at July and August, they are much better than 10% of the total revenues. And the growth has been very significant. In fact, the growth over last year of e-commerce is somewhere in the range of about 200% compared to period last year, July, August. So I'm talking about July, August more than Q1 to give you a sense, as to where the market is headed. And of course, the buyer purchasing modes have changed. People do prefer to be hands-off and buying online, and it happens across all sectors. And so e-commerce has started doing well, which is good for us. But in terms of the margins and the investment that we make into e-commerce, it is more or less similar to all other channels, because as you know, the MRP of any jockey product, whether you buy in an MBO or you buy in an EBO or online, it is exactly the same. There is no off-season, there is no discounting. So by and large, we have costed things in a way that nearly all channels give us similar EBITDA margins.
So I don't want to get this one wrong for our viewers. What essentially you are saying is that you are very confident that 20% growth for Page Industries is coming, and it may actually happen in this year?
20% growth for the rest of the year, say about 7-8 months on a full year basis. We'll have to wait and watch. Equally like you, we also hope that kind of growth comes, and we are prepared both at the back end, meaning manufacturing and warehousing, and the front end, which is the distribution and sales. So it is early to call, but yes, August is a pretty good indication of that the demand is somewhat back.
Now, when we spoke last, you had mentioned that you are rebooting and you are revisiting all your cost and line items, and you've individually looked at a lot of processes where automation and transformation could happen. Could you share more details on that? On the raw material cost, are you able to kick in some efficiencies? Are there any process and automation processes which you've already started implementing which significantly could change the future profitability curve for Page Industries?
The raw material costs more or less remain the same. There is a procurement control which works between plus or minus 1% in terms of the raw material prices. So though we are trying to work on certain optimization of procurement itself, for the near future, we will remain around that kind of raw material costs only. What we have done is more with respect to the other OPEX, including the wages, the factory overhead, the selling overhead, the advertisement, and the corporate overhead, where we have made a significant reductions even over Q4 and over Q1 of last year. And that is what has benefited us. In fact, if you look at the cash and cash equivalent, we are significantly better than at any time in the past. We have about 1,700 million rupees of cash and cash equivalent, which was only about 1,100 in the quarter ended March. It was around 1,400 plus Q1 of last year. The working capital has reduced from 4,600 in March to about 4,100. Last year, this time in Q1, it was around 5,300 million rupees. So we have done a lot of work. We've done a lot of homework on zero basing. We've done a revised budget as soon as April. And we had actually predicted much lower revenues and in Q1 in the month of April, but we improved upon it. So we are prepared to manage the cash flows, the working capital, and we have not borrowed any funds even till date, right from Q1 or even in the past. So we remain net debt free. So some of the the strong balance sheet, the strong financial practices of our company is helping us. Not only us, we are paying all the vendors earlier than they're asking. Many of them on time. So many of these small and medium enterprises need support. They need to remain afloat because they are our trusted vendor partners. So they have to pay their wages, salaries, their rents, and all other OPEX, and they should be able to produce. There may be certain attendance issues and in the units due to COVID. So they may not have the full labor force to produce and supply, but unless they produce and sell, they will not remain in business. So it is in many ways a question of survival for many of the vendors. So we are supporting them with good payments. We have improved our payments to them. And despite that, we have an extremely good cash position at the end of Q1 and even now in August. So it's a pretty well managed. We have learned a lot during this phase, which is unprecedented. But at the same time, what are the right things to do? What are the good practices? How we have retained all our employees. We have allowed everyone to rejoin.
European funds, or in this case a specific fund, has raised concerns that Page Industry is not following best manufacturing practices, and that is something which bothers them. How would you defend it? We have been in India for 25 years. We employed at any time 17,000 to 20,000 people. 80% of them are women. So we have 8 hours work, and we have very strong policies as to not only the treatment, but also the safety and free lunch and health and so on. Even we run creche for the infants of the women employees who come to work. We provide free transportation to all because most of our units are in either semi-urban or in rural areas. So we provide transportation so that the women reach back home on time.
So this is not now. This has been the practice and the philosophy of the promoters and the brand in India for the past 25 years. We haven't changed anything from that philosophy. And that is the reason while many of the other sectors and industries were forced to lay off, cut salaries, and let people go, we have not done any of that, including the outsourced manpower we had. We have paid all of them in full during the lockdown period. And all our labor, our workers are on roll. We don't have casual labor at low cost like some of the other industries. So our practices are founded on fundamental ethical and something which supports the employees, and that is the reason we have grown.
So how are you planning to address these concerns? Have you reached out to them? Are you looking at getting your manufacturing facility audited by independent companies so that there is a validation in whatever you've said?
We have also published a sustainability report for the past 2 years. So I would encourage people to go through all the practices which are transparently available in public domain. We follow all the laws of the land. We have no cases pending against us relating to labor or factory compliance. We have not received any notices from any of the labor or statutory bodies. So we have been in business long enough to know that it is people intensive, and we have to take care of people very well. And beyond that, individual, for example, any activist wanting to investigate is something we'll have to consult our own, lawyers and see whether it is possible. But we have responded quite categorically to the people, to the investors or the fund, and we have given our replies. And there, I think the matter would rest.
So the growth, Mr. Chandrasekar, for Page Industries, will this be a function of premiumization, which is moving up the value chain, or reach?
We have, the market is so huge. I think we also spoke about it in some of the previous interaction. The men's innerwear market is itself growing at about 11% year on year. And the women's innerwear market is growing at about 12.5% year on year. And it is expected to touch women's innerwear like about 68,000 crore by 2028. From a size of about current market size of 21,000 crore. The men's innerwear market is currently around 35,000 crores, and it is growing at, as I said, about 11% CAGR, and it will touch about 90,000 crore. Based on these are published and authentic data sources, like for example, Images Business of Fashion. So it is men's innerwear market is expected to touch about 90,000 crores by 2028. So given this market size, and in addition, the athleisure or the outerwear market is about 54,000 crores. So given this market size, you would know that we are extremely small in that market, because the premiumization will continue to happen. And even if we grow at this rate, which the market is growing, we will sort of retain a similar market share. The issue is not about market share or competition, but the issue is about how do we reach out more in terms of geographical spend. How do we offer the variety for the men, women, and the kids wear market, and how do we grow along with this market? So that is something which is happening. So in the past few quarters, we haven't seen that, and COVID became a dampener. But we were always investing in this growth 2 or 3 years ahead of time. We had invested in digital transformation, business transformation, and automation of the front end and the back end. So these investments will resume. When the business is back to normal levels and we are seeing growth over the previous years, we will sort of resume the capex and other investments into the business, because this market is definitely out there.
All right, Mr. Chandrasekar, appreciate your time. Thank you for joining us. Stay safe and have a great day ahead.